From a messaging perspective, we witnessed a turning point from Canada's central bank. The focus, once solidly on how to tame sticky inflation, has now shifted to economic growth. And though the central bank didn't flat out say we should expect a June rate cut, the Bank of Canada governor didn't rule it out either.
Yes, it's within the realm of possibilities. If you look at our indicators, they're not all progressing at the same speed, but they've all been moving in the right direction.
Main sticking points on the inflation front include persistently high shelter costs, both for rents and mortgage interest costs. So there's nothing the Bank of Canada can do about rents, but a rate cut would bring relief to many homeowners and help keep a lid on shelter inflation. RSM economist Tu Nguyen warns that if the bank doesn't cut in June, the Canadian economy risks trailing its peers.
If the Bank of Canada waits any longer than that, it's going to put Canada behind other countries in terms of growth. Because the moment rate cuts begin, that is a signal for businesses to begin investing and hiring again.
The bank has to walk a fine line. It needs to communicate its next steps without unintentionally driving up inflation. Remember January 2023 when Macklem said there would be, in his words, a conditional pause in rate hikes. It sparked a 5-month rally in home prices. But the central bank says it won't budge now until it's sure that inflation is under control.
We are encouraged by what we've seen since January.
There are risks from outside our borders, geopolitical tensions that could spike gas prices, conflicts that could stoke global food prices and drive up shipping costs. A strong U.S. economy could kick up inflation here, too. Barring any wild card events, the central bank sees inflation subsiding to around 2.2% by the end of 2024. Anne Gaviola, Global News, Toronto.